Today we are diving straight into an analysis report. It's called Opening Bell, Why MSTR is My Number One Stock to Watch This Week.
Yep.
It's arguing that MicroStrategy, MSTR, is a really compelling buy-the-dip play after that sell-off on Friday. The conviction is there, but, we found a few areas to make the whole thing undeniable.
I agree. I mean, the core idea is clear. MSTR is undervalued.
Right.
But for an instrument this complex, the analysis has to get ahead of the market skepticism. So let's just jump right into that first big opportunity.
Okay, so the core of the piece, the hook, it really relies on this huge valuation gap. So the analysis makes a powerful case for massive potential upside by citing these high Wall Street analyst targets, but it really needs to dig deeper into the systemic reasons for the current price divergence.
That is absolutely the elephant in the room. The piece uses the current price, what is it, 176.45?
Yeah, around there.
And it puts that right up against the average analyst target of over $530.
And a high of 740.
A high of 740. I mean, the writer correctly says, do the math. That is massive upside potential.
But here's the weakness. Here's the thing. The analysis doesn't really address why. Why is the market discounting MSTR so heavily right now?
Exactly.
It mentions generic profit-taking for the Friday drop, but that doesn't explain this multi-$100 chasm.
If the pros see 3 or 4x upside, why is the stock just sitting there?
The price itself is sort of a counter-argument.
It is. If the market genuinely believed 530 was the floor, the price wouldn't be anywhere near 176.
No way.
So to really strengthen the bullish claim, the analysis has to dedicate some focused space to analyzing the nature of that discount. The writer needs to assume there's a very rational, silent, bearish argument being priced in and then just take it apart, piece by piece.
That's the key difference, isn't it? Between just, citing a target and actually integrating it, you have to identify the reasons for the discount.
You absolutely do, and you need to give us some concrete theories.
Like what?
Well, for example, is the current price reflecting a kind of liquidity discount? Because of MSTR's corporate structure versus, say, a pure Bitcoin ETF.
Or maybe it's a conglomerate discount.
What do you mean?
Like, the market hates the legacy software business so much that it's actually punishing the Bitcoin holdings because of it. The analysis needs to look at those possibilities.
Okay, yeah. And then if we're really talking about that 740 target, the piece has to connect the dots explicitly.
How so?
The writer should lay out the assumptions needed to hit that number. Like, what does Bitcoin's price need to be? What about future dilution risk? And then contrast those with what the market is clearly assuming today.
Right. Explaining that gap is what elevates this from, an energetic pitch into genuinely robust analysis.
It makes the conviction feel earned, not just stated. Now, building on that idea of structure, the second big critique is really about MSTR's core mechanic, the leverage.
Ah, yes, I see where you're going. So, critique 2. While it correctly identifies MSTR as a Bitcoin multiplier, the analysis needs to more systematically integrate the inherent risks that come with its leverage structure, rather than just relying on a technical stop loss.
The initial framing is, I think, brilliant. MSTR is pitched as a leveraged Bitcoin ETF.
Yep.
And the writer stresses that it's mispriced and undervalued if Bitcoin just held steady over the weekend. The whole selling point is the upside from that leverage.
But, and this is the big but, when we talk about risk, the analysis just gives us a single, extremely tight technical stop loss at, 174.50?
Yeah.
The whole focus is on the upside multiplier. But the leverage that creates that multiplier, its fundamental risks are just completely sidestepped.
And for this kind of audience, a technical stop loss just doesn't cut it. It doesn't address the fundamental downside. Leverage completely changes the risk profile of the whole balance sheet.
So the suggestion is...
The suggestion is that the analysis has to elevate the discussion of MSTR's leverage structure from just a concept, a hook, into a fully integrated risk framework.
Right. When you pick MSTR over a spot ETF, you are explicitly choosing to take on debt risk. We need to see that risk modeled out.
Yes, the writer should be outlining the potential impact of a rapid, sudden drop in Bitcoin prices. And not just on the stock price.
But on the corporate balance sheet itself.
Exactly. We need to see the implications, like what about potential collateralization calls if certain debt thresholds are hit? Or how a long downturn might affect their ability to keep buying more Bitcoin. That's the real high-stakes risk of the multiplier.
And this is where a concrete example would really drive it home.
For sure.
Provide a clear comparison, a sensitivity analysis. How does a 10% drop in Bitcoin affect MSTR compared to, say, a non-leveraged instrument? Showing that math, that direct comparison, It would fully establish the high-stakes risk-reward dynamic. It gives the reader confidence that the writer has truly weighed both sides.
If you don't talk about the leverage risk, the reader just assumes you're either unaware of it or you're trying to minimize it. And neither of those builds conviction.
Which brings us to our final point. And this one is really about clarity of purpose. I feel like the analysis is trying to do two things at once, and it ends up diluting the message.
I saw that right away. Okay, so critique 3. The persuasive case for an immediate reversal trade is slightly undermined by the confusing temporal scope, which mixes precise short-term trading signals with multi-year fundamental justifications.
It's a total mismatch of timelines. On one hand, you have this incredibly tight, high-conviction swing trade setup. Critical support at 176, a stop loss at 174.50.
A $1.50 risk?
Right. And a bullish target of 185.25. I mean, that is a razor-thin technical setup for the next few hours or maybe days.
But then the main reason for that high conviction is coming from analyst targets all the way up at $740.
Which implies a multi-month or even multi-year hold.
Exactly. The whole argument is straddling a short-term technical trade and a long-term fundamental investment. It's like you're mixing day trading rules with Warren Buffett's conviction.
And that's the weakness. To get more focus, the analysis has to clearly define its objective. Is this a quick-hit technical trade based on that Friday flush? Or is the 176 entry point a key signal for a sustainable multi-period investment thesis? The data you use has to align with that primary goal.
Because if the main focus is that quick reversal, that pop to 185, the risk and reward are purely technical. Bringing up the 740 target is just noise.
It is, yeah.
It just confuses the reader. Are they supposed to respect that super tight stop? Or should they hold through the pain because the long-term target is so high?
Right. So for that quick reversal trade, the concrete examples are simple. Just remove or, heavily quarantine those 530 to 740 analyst targets. They introduce all this unnecessary long-term complexity, and it makes a $1.50 stop loss seem, frankly, ridiculous.
Or, and I think this might actually be the stronger path, given the conviction here, if the 740 potential is the real driver, then the analysis needs to completely redefine the risk tolerance.
It has to.
The writer should spend time explaining why the risk should go beyond that very restrictive 174.50 stop.
A long-term investment entry should probably talk about, a scaled entry strategy, or reference fundamental support levels further down, maybe that 170 level that's mentioned.
Right. Places where a real investor would actually add to the position, accepting short-term technical pain for that long-term fundamental gain.
The audience just needs a clear directive. Right now, the piece is essentially saying, buy this right now because the long term is great, but sell it immediately if it moves against you by less than 1%.
That mixed message just kills the clarity of the call to action. You gotta pick a lane and drive hard in it.
That's a perfect way to put it. This analysis has some really strong raw material, and the conviction in MSTR is obvious,